Hey, what's up guys? Welcome to another episode of Real Life CFA. In this series, we're going to talk about all the important concepts in the CFA curriculum and real life applications. Let's get right into it.
So today, let's talk about supply and demand. This is one of my favorite theory of all time. It's very simple and very useful. As always, let's start with the definition. What is the law of supply and demand? It's a theory that explains the interaction between the sellers and the buyers. The theory defines the relationship between the price of a given good or product and the willingness of people to either buy or sell it. So this is the diagram for supply and demand model. The red line represents supply and the blue line represents demand. And in the middle, where those two lines intersect, that point represents the equilibrium level. What it means is, at that point, the quantity of supply equals the quantity of demand, and the price is the market price. Now remember this diagram, it's very important. Now let's talk about demand. When demand increases, you shift the blue line to the right while keeping the supply unchanged. This will result a higher equilibrium price and a higher equilibrium quantity. If demand goes down, you shift the demand line to the left. It will result a lower equilibrium price and a lower equilibrium quantity. It makes sense, right? Supply stays the same, demand goes up, price goes up. Demand goes down, price goes down. When the demand of this product goes up, which means in the market there are more people willing to buy this product, then the supplier can charge a higher price, and vice versa. Now let's talk about the supply. If we assume the demand stays the same and supply goes up, then you shift the supply line to the right, which will result in a lower market price. If supply goes down and you shift the supply line to the left, will result in a higher market price. So when there is an imbalance of supply and demand in the market price will adjust and a new equilibrium will be formed. Let's look at some real life examples to help you understand this concept. The first one that we're going to look at is what happens when OPEC announces a production cut. And the product that we're talking here is crude oil. So when OPEC announces a production cut, which means there will be less supply of oil in the market, so you need to shift supply curve to the left, which will result a higher oil price. Simple enough. Let's look at the next one. What happens when a company announces an earning beat? Meaning that the earning announced by the company is higher than the estimation of Wall Street analysts. And we know that the valuation of a company depends on the company's earning, cash flow, and other fundamental factors. So when a company announces an earning beat, which means the actual earning is higher than what the market expects. So the valuation of this company suddenly goes up. But this will not directly impact the share price in the secondary market. So what happens is a higher valuation will attract more investors, which means more demand for this stock. So you have to shift the demand curve to the right. And this move will push the share price in the secondary market to go higher. Because now, with the constant supply of the shares, more people want to buy it. Let's look at the next one. What happens when a company announces that they want to issue more shares? The product we're talking about are the share of a company. So when this company announces that they're going to issue more shares, meaning that they're going to supply more of this product to the market. So there's an increase of supply. So you need to shift the supply curve to the right to adjust for that change. This will further result price drop in those shares. Next, what about when the central bank announces a rate cut? The main function of a central bank is to control the economy by controlling the money supply. A rate cut means more liquidity, meaning more supply of money in the market. So the product that we're talking here is money, and price of money is interest rate. So if there is an increase in supply of money, you shift the supply curve to the right, and this will result a lower price of money, which is a lower interest rate. What about quantitative easing? The same thing. Quantitative easing is just another method that the central bank use to increase money supply to stimulate the economy when we're in recession. So there's an increase in supply of money, you shift the supply curve to the right, and this will result a lower price of money, which is a lower interest rate. So when a central bank announces QE, bond yields tend to fall. So this is in the aspect of money supply and demand. We can also explain QE using the bond market. When a central bank announces for QE, most of the time they're buying bonds, meaning that the demand for bonds go up and price of bond go up, and the yield on that bond has an inverse relationship with bond price. So when bond price goes up, interest rate goes down. So these two are basically explaining the same thing, but it's just with different perspectives. So that's a brief introduction of the supply and demand model. I hope you liked it.
If you like this video and wish to see more contents like this, please like and subscribe. Thank you very much for watching, and I'll see you next time.